Welcome to Brain on Books YouTube channel. Today we're diving deep into something really powerful, I think. It's a strategy for building real financial independence. And look, we're not talking about those high-risk trading things or, the latest crypto fad. No, our focus today is squarely on generating, well, self-made wealth, but doing it by studying how the ultra-rich actually structure their finances. It's about simplified, confident investing, the kind that creates passive income streams that last.
Exactly. It's like you said, it's the blueprint of the billionaires, but, distilled down so anyone can use it. When you really look at the self-made wealthy people, the ones who built these huge companies, you see they pretty quickly shift focus. It's not just about the company anymore. It's about structuring their whole financial life around investments. The business, yeah, that's the engine, generates the cash. But the holding company, that's the fortress, protects and grows the wealth. Forever, really.
Right, and we see how they make it official almost. Setting up these massive holding companies, they act as these financial shields, don't they? Legally separating the day-to-day business income from their long-term wealth plan.
Absolutely. I mean, think about Bill Gates. All that Microsoft money, it didn't just sit there. It got funneled strategically into Cascade investment. And Cascade isn't just a big bank account, right? It's a seriously sophisticated investment machine. Holds everything. Blue chip stocks, bonds, huge amounts of real estate, stakes in solid companies like Republic Services, John Deere. He basically turned his operating income into diversified investment income, systematically.
Or, yeah, the classic example, Warren Buffett. Berkshire Hathaway, it's the perfect picture of this whole approach, isn't it? Berkshire is just a holding company that invests in, sometimes buys outright, these super stable cash-generating businesses.
Foundational brands, Coca-Cola, See's Candy, P&G, companies that just consistently pay out, and those payouts grow.
And it's not just an American thing either.
No, not at all. You see the same pattern globally. Look at Carlos Slim in Mexico, telecom guy. His conglomerate, Grupo Carso, that's his investment vehicle, holds all sorts of stuff. Media like the New York Times, big regional players like America Mobile, or Amancio Ortega, the Zara founder, uses that huge retail success to fuel a holding company that's heavy into prime real estate, other non-retail things, all designed for long-term income.
Okay, so for the listener at home, right, we're not setting up a multi-billion-dollar holding company tomorrow. Why should we care about how Gates or Buffett have things set up?
You should care. Because the structure tells you their priority. They move liquid cash from operations into stable, diverse income-producing assets. That's the key. They're after perpetual realized income, you see, not just hoping the asset price goes up. Their complex setup is just the big league version of what we're talking about today, the dividend snowball. We just watch how the top players manage their capital, and we copy the simple underlying strategy. Turn today's income into forever income.
Okay, let's get the ball rolling on implementing that. Let's start with what stops so many people. That feeling of, I just don't have enough money. We'll call this section 1, brazen financial awareness and stock fundamentals.
Yeah, that I don't have enough money idea. That's probably the biggest hurdle. It just leads to doing nothing. But the sources we looked at are clear. Starting small isn't just okay. It's actually, well, it's critical. Especially if you're new to this or maybe still paying down debt. You've got to commit to starting small, even if it's just, say, $10 a week.
And $10 a week, that adds up, right? $520 a year. That's definitely enough to start buying shares in really good companies. But the real win there, it isn't just the money, is it? It's the psychological part.
Exactly. Starting small lets you build confidence. You learn through small mistakes. Because, let's be honest, investing has risks. You will have losses sometimes. Even with great companies, markets get choppy. If you jump in with your entire life savings right away, you'll be terrified, scared to make a move. But if you start with that $520, you can learn, make a mistake, which you probably will bounce back, and build that resilience you need for the long haul. It's like behavioral finance 101.
So it reframes starting small. It's not about the dollar amount. It's like paying tuition to learn how to handle the ups and downs. And like you said, some of these big, solid companies, you can get a piece of the action pretty easily. One share of Coke, often less than $50.
Right. So the first practical step, automation. Set up those automatic transfers, $20, $50, $100 a week, whatever fits your budget right now, straight into your investment account. That's the whole pay yourself first idea in action. Use the set it and forget it method. You just build capital steadily, systematically, takes the emotion out of the saving part.
Okay, but let's pause for a sec. Why the stock market specifically? Why not real estate or gold or something else? Why is this still seen as the best place to build wealth?
Well, it really boils down to one main enemy. Inflation. The stock market, yeah, it's volatile, no doubt, but historically, it gives you the best probability of growing your money faster than inflation eats it away. Inflation, averaging around 3.5%.
Yeah.
It's constantly chipping away at your buying power. If your money's just sitting in a savings account earning next to nothing, or worse, under the mattress, you're losing ground every single year. The wealthy put their money where the growth beats the decay. Simple as that.
Okay, so just to make sure we're all on the same page, the absolute basics, what is a stock? But let's focus on what owning it really means, not just the textbook definition.
Right. A stock or a share is just a tiny piece of ownership in a company.
Yeah.
PepsiCo might have billions of shares out there. If you own 100 shares, okay, you're a small owner. But the point is, you are an owner.
And that ownership actually comes with rights, doesn't it? Which ties back to what you were saying about control.
Precisely. Owning stock gives you the right to vote on how the company is run.
Yeah.
Usually one vote per share. Now, if you gather enough shares, your vote starts to matter. And that connects right back to the billionaires, right? They don't just own shares. They own controlling chunks through their holding companies. That gives them huge influence over big decisions like whether dividends get paid or increased or even cut. It matters.
It's amazing this isn't some newfangled idea. It's ancient, really.
Oh, yeah. The very first known stock certificate, the actual paper proof of ownership, came from the Dutch East India Company, the VOC, way back, early 1600s. Yeah, and the VOC is a perfect example historically. They basically invented this whole mechanism. They needed huge amounts of cash for these risky, long sea voyages. So they sold shares to the public, spread the risk around, and in return for putting up the capital, shareholders got a cut of the profits, a dividend. It set up the basic deal. You provide the money, you get a piece of the earnings, a structure that's amazingly lasted centuries.
Okay, foundation set, ownership established. But just owning something doesn't mean cash in your pocket, right? So the next logical question is, how do owners actually get money out of these shares? Let's move into section 2, the 4 ways to profit from the stock market.
Yeah, understanding these 4 ways is pretty important. It helps show why we're going to focus so heavily on that last one, dividends, as the most reliable path to, well, financial freedom.
Method 1. This is the one everyone thinks of, this sort of speculative way. Buying low and selling high, capital appreciation.
Right. Profit for the difference between what you paid and what you sold it for. But the key thing here is realized versus unrealized income. Let's say you buy a stock for $500 and it goes up $600. Okay, great. You've got a $100 gain on paper. But that's unrealized. You can't spend it. You only realize that income, turn it into actual cash when you sell the shares. It totally depends on the market going up and you timing it right.
Method 2 is the opposite, basically. Going short, selling high and buying low. This sounds riskier.
Oh, it is. Significantly riskier. You're borrowing shares, usually from your broker. Then you sell them immediately, hoping the price tanks. Then you buy them back cheaper, return them to the lender, and keep the difference. Like, say, a stock's at $10. You borrow and sell 100 shares, get $1,000. If it drops to $7, you buy back for $700. Return the shares, pocket $300, minus fees, of course. The danger? Well, a stock price can theoretically go up forever. So if you bet wrong and the price skyrockets, your potential loss is unlimited. That's pure trading, really, not investing for income.
Okay, method 3 gets a bit more complex. Selling call options. This starts to sound more like generating income from owning the asset, not just betting on price.
Yeah, selling call options, or more specifically, covered calls if you already own the stock. It's a more sophisticated way to generate income. You're basically selling someone the right, but not the obligation, to buy your shares from you at a set price, the strike price, before a certain date. And for selling them that right, they pay you a fee up front. That fee is called the premium.
Okay, that sounds a little complicated. Let's use our Coke example. How does selling a covered call put cash in my pocket right away?
Okay, let's say you own 100 shares of Coke you bought at $38. You want some income while you hold it. You could write an option contract agreeing to sell those shares at, say, a $40 strike price. And for that right, you charge a premium, let's say $1.20 per share. The moment you sell that option contract, boom, $120 hits your account. That's instant cash, realized profit. Now, if Coke stays below $40 until the option expires, the option is worthless to the buyer. You keep the $120 premium, and you keep your 100 shares of Coke.
The catch, then, is you miss out if the stock suddenly takes off.
Exactly. If Coke shoots up to $50, the person who bought the call option will exercise their right to buy your shares at $40. So you made a profit on selling the stock. $40 strike minus your $38 cost equals $2 per share, or $200 total. Plus, you keep the $120 premium. So $320 total profit. That's not bad. But you missed out on the bigger gain you'd have had if you just held the stock until $50, which would have been $1,200 profit, $38 times 100. Covered calls are something dividend investors might use sometimes just to squeeze out a bit more income, but it does put a ceiling on your potential capital gains.
Right. Which brings us finally to method 4, the real core of this deep dive, receiving dividends.
Yes. This is passive income in its purest form, really. A dividend is just cold, hard cash, paid out regularly, usually every quarter here in the U.S., straight into your brokerage account. It comes directly from the company's profits, paid out to you as an owner, requires zero action on your part, no selling, no contracts to watch, just steady, reliable income. It's a heartbeat of that billionaire strategy we talked about.
And the really critical point here, the thing that separates smart dividend investing from just chasing high yields, is that growth rate, isn't it?
Absolutely fundamental. You have to be ruthless about this. Only look for stocks that increase their dividend payments faster than inflation every single year. If inflation is humming along at 3.5%, your company only bumps the dividend by 2%, well, over time, your actual spending power is shrinking. The goal isn't just income, it's income that actively grows your wealth, beating inflation year after year.
Okay, that leads us perfectly into section 3, the secret to financial independence, the dividend snowball. This is where we move from mechanics to the philosophy behind it all.
Yeah, the philosophy is pure value investing, really.
Yeah.
You buy shares in really high-quality companies you can understand. You buy them when they're on sale at a discount. You hold them for the long term, and you collect those dividends that ideally keep growing. The whole focus is on generating realized income cash you can use without ever having to sell the underlying asset that's producing the income.
And that gives us a really clear, measurable definition of financial freedom for someone following this path, right? It's reaching that point where the reliable cash coming in from your dividends equals, or even better, exceeds the income you make from your job.
That's the liberation point. Once you cross that line, you're living entirely off the cash flow from your investments. You're not really dependent on the market's daily mood swings anymore, and you're naturally hedged against inflation, because if you chose wisely, that income stream just keeps growing faster than the cost of living.
It really paints that picture of the tortoise versus the hare in investing, doesn't it? Capital gains are the hare-flashy, exciting promises of getting rich quick.
But also prone to crashing and burning spectacularly.
Exactly. The dividend is the tortoise. Slow, maybe a bit boring to some, but incredibly steady and reliable. And that reliability is everything when things get rough economically. We know about companies called dividend aristocrats, J&J, P&G, Unilever, names like that. They've raised their dividend every year for decades. And crucially, they kept paying and kept increasing those dividends right through the 1929 crash, the dot-com bust in 2000, the 2008 recession. Asset prices were collapsing all around, but the income stream for their shareholders, it stayed intact. Often it even nudged up a little.
And the snowball effect, compounding, that's what takes that slow, steady growth and turns it into something huge over time. Turns the tortoise into like a steamroller. Precisely. When you take the dividends you receive and immediately reinvest them, buy more shares of the same stock, or another good dividend stock. Those new shares start spitting out their own dividends, which you then reinvest. It just builds on itself. The source material pointed to Coca-Cola's track record. They've paid an increasing dividend for 50 years straight. And look at the acceleration. Over the last decade, that dividend grew, on average, almost 9% a year, 8.96% to be exact. Now compare that to inflation, maybe 3.5% long-term average. Coke's dividend growth is crushing inflation by over 5% every single year. That means your actual spending power from that dividend is growing exponentially. That's the magic of compounding.
Now, to manage this properly, you do need to understand the timing, right? The dates involved. It's not just random when the money shows up.
Yeah, there are 4 key dates you need to know for planning. First up is the declaration date. That's when the company's board officially announces, okay, we're paying this much dividend on this future date.
Then the really important one for buyers, the ex-dividend date.
Crucial one. You have to own the stock before the market opens on the ex-dividend date to get that upcoming payment. Buy it 1 minute after the market opens on that day. You miss out. The dividend goes to the person who sold it to you.
Okay. Then there's the record date.
Right. That's more of an internal thing for the company. It's the cutoff date they use to check their books and see who officially owns the shares and gets the dividend, usually a day or two after the ex-dividend date. And finally, the best one, the payment date. That's the day the cash actually lands in your brokerage account, ready to be reinvested or spent.
It's worth hitting this one more time. The difference between This dividend income and capital gains, this is realized income, right?
Yes. The moment it hits your account, it's real spendable cash. It's the essence of passive income. You didn't have to sell anything. You didn't have to liquidate your asset.
It's like you said, you're not stripping parts off your car to buy gas. The car is generating the gas for you.
And the fuel just keeps getting better, higher octane year after year if you pick the right car.
Okay, let's shift gears now into section 4, critiquing alternatives and navigating market turmoil. Because look, if this dividend strategy is so good, we need to understand why the things most people do use often fall short for long-term passive income. Let's start with the safest option, the savings account.
Yeah, savings accounts. Fundamentally, they're a losing game for preserving wealth. We mentioned inflation, but let's put numbers on it again. If inflation is steady at 3.5%, that dollar you have today, next year it only buys 96.5 cents worth of stuff. Fast forward 20 years, that same dollar only buys about 50 cents worth. Its purchasing power is cut in half. Savings accounts, basic CDs, they pay tiny interest rates that just don't keep up, so your capital is just slowly, quietly being eaten away.
Okay, what about mutual funds? They seem popular, offer diversification, but there's a catch.
A big catch: high fees and no control. Mutual funds are actively managed, which means you pay for that manager. You've got management fees, administrative fees, sometimes load fees just to buy in, and the big one, the expense ratio. An expense ratio of, say, 1% might not sound like much, but on a $500,000 portfolio, that's $5,000 every year going to the fund company, not compounding for you. Over 30 years, those fees just carve out a massive chunk of your potential returns. Plus, you give up your shareholder voting rights. The fund manager calls all the shots.
All right, but what about the newer options? Index funds, ETFs, they have super low fees, often close to zero. What's the issue there?
The low fees are definitely a huge plus. Can't argue with that. But the potential downsides are in their structure and maybe taxes. Structurally, an index fund just mirrors an index, like the S&P 500, which means you inherit its built-in biases. The S&P 500 right now, for example, is really heavy in tech, over 21% in information technology, which can be super volatile, and it's really light in stable dividend-paying sectors like consumer staples under 10%. So if the tech sector takes a nosedive, your whole index fund gets dragged down hard because you're forced to hold so much of it.
And taxes. Aren't index funds supposed to be tax efficient because they just buy and hold?
They can be for capital gains, since you only pay tax when you sell your shares. But the fund itself still has to buy and sell stocks sometimes to rebalance or track the index changes. When it sells stocks at a profit, it has to distribute those capital gains to you, the shareholder. So you can end up paying capital gains tax even if you haven't sold anything yourself. Dividend stocks, yeah, the dividends are taxed as income regularly, but it's cash you can actually use or reinvest immediately. Gives you flexibility that unrealized gains in an index fund don't always offer.
This whole critique leads naturally to that standard retirement advice that dividend investing aims to replace the 4% rule.
Ah, the 4% rule. The idea is you can safely withdraw 4% of your portfolio value each year in retirement, and your money should last. But it rests on some shaky ground, I think. 3 main flaws. First, it forces you to sell your assets to create income. You're literally shrinking your portfolio, reducing its ability to grow in the future is a strategy of, well, gradual self-liquidation.
Second, market timing becomes a huge risk, doesn't it?
Massive risk. Imagine retiring and the market immediately crashes 30%. Now you have to withdraw your 4%, but you're selling those beaten down assets at the absolute worst possible time. You lock in those losses permanently and drastically shorten how long your money will last. It's terrifying.
And the third flaw, inflation again.
Always inflation. That 4% withdrawal might be $50,000 in year one, but with 3.5% inflation, 20 years later, that same $50,000 only buys what $25,000 buys today. You need an income stream that actually grows in dollar terms to maintain your lifestyle, not a fixed percentage withdrawal that loses purchasing power every year.
Understanding these past market crashes isn't just about critiquing other methods. It's about building that psychological armor for the dividend investor, right? Seeing crashes as opportunities.
Exactly. Look at 1929. What really fueled that crash, beyond the speculation? Massive leverage. People buying stocks on margin, borrowing huge amounts. When prices dipped even a little, brokers made margin calls, forcing people to sell everything to cover the loans. Panic fed on itself, led to the creation of the SEC, trying to prevent that kind of leverage frenzy.
And the 2000 dot-com bubble, that was pure mania.
Total mania. People ditched solid, profitable companies to chase internet startups that had never made a dime, valuing them on website clicks instead of actual earnings. Lots of shady stuff, too. Insiders pumping up the stock price, then dumping their shares onto naive retail investors.
Then 2008, the Great Recession, housing bubble, subprime mortgages, showed how interconnected and fragile things can be.
Yeah, systemic crisis. But here's the key takeaway, the really crucial point for dividend investors, using PepsiCo during that 2008-2009 meltdown as an example.
Right, what happened with PepsiCo?
Okay, so the stock price got hammered, fell almost 40%, from around $78 down to $47. Wiped out huge amounts of paper wealth for capital gains, folks.
Yeah.
But PepsiCo's management, they held the line on the dividend. They didn't just maintain it. They actually increased the quarterly payout. Went from 43 cents to 45 cents a share, right in the middle of the chaos. That's a 6.6% increase from 2008 to 2009. That single fact tells you everything about the stability and reliability we're looking for. The market was burning down, but the income stream actually grew.
That's the kind of stability we're hunting for. Okay, let's pivot to Section 5. Fundamental analysis, uncovering great companies. How do we find these reliable tortoises?
Well, the definition of a truly great company, for our purposes, is one that consistently grows both its total revenue and its net income, year after year. Revenue, that's the top line, all the money coming in from sales. Net income is the bottom line, the actual profit left after all the costs, interest, taxes are paid. We want to see both those lines trending upwards, ideally smoothly, over time.
So what does that look like in the real world? Any good examples from the data?
Sure. Fastenal was mentioned. They sell industrial supplies, things businesses need. If you look at their chart, revenue and net income just climb steadily, like clockwork almost. There was a tiny dip in the 2009 recession, then right back to growth. That shows resilience, a necessary product. Estee Lauder is another one. Consistent revenue growth. But after 2009, their net income really took off. Management figured out how to become much more profitable, boosting their margins. That shows efficiency.
And conversely, what are the warning signs? What tells us to stay away?
Inconsistency is the big red flag. Sprint, for example. Their revenue was basically declining for years after 2007. And their net income, often negative. They were losing money. American Airlines, after the recession, also had years of net losses. It was very up and down. A company that can't reliably make a profit, eventually it runs out of cash, can't pay its debts. And the first thing to go, usually the dividend. We need bulletproof consistency.
And that consistency is often protected by what Buffett calls the moat, right? The company's competitive advantage.
Exactly. The moat is what keeps competitors at bay, allows the company to stay dominant and profitable. It could be powerful brand recognition. Think Coke or Colgate or Band-Aid like Johnson & Johnson. People ask for the brand. Or high switching costs, maybe complex software or your bank. It's a pain to switch. Sometimes it's a geographical monopoly like a utility company, though they often come with a lot of debt. The moat is why you'd still buy that Band-Aid, even if a generic is a bit cheaper.
And there's a simple test for that moat, isn't there? The 10% price increase test.
Yeah, it's brutally effective. Ask yourself, would customers still buy this product if the price went up 10% tomorrow? Things like sugar, cement, basic airline tickets. They fail this test instantly. People just buy the cheapest option. Commodities. But companies selling those cash cow products, the same stuff people have bought for decades, like Tide detergent or Pepsi or Hershey's chocolate, they often have incredible moats. They don't need constant, expensive innovation. They just defend the brand, manage distribution, allows for high, steady profits.
Okay, beyond the moat, we need to look at the financials, how management handles the money. Let's talk stock buybacks first. How do they help me as a shareholder?
All right, stock buybacks. This is when a company uses its extra cash to buy its own shares back from the market. What does that do? It reduces the total number of shares out there. So your existing shares automatically represent a bigger percentage of the company. Imagine a company goes from 1 million shares down to 400,000. If you own 10,000 shares, your ownership just jumped from 1% to 2.5% without you doing anything. It also boosts earnings per share, the EPS, because the same profit is now divided by fewer shares. Makes the stock look cheaper, makes the dividend look safer. It's generally a good sign management's shareholder friendly.
Good point. Second key metric, debt. Too much debt can sink even a good ship, right?
Oh yeah, debt is a killer if it gets out of hand, especially in a downturn. We look at the debt-to-equity ratio, or DE. Ideally, we want that below 1. Means the company funds itself more with owner's equity than borrowed money. Even better, figure out how many years of pre-tax profit it would take to pay off all the company's debt. The goal there is 5 years or less. McDonald's back in 2014 was around 3.3 years. Very healthy, but you do have to consider the industry. Utilities, for example, naturally carry more debt because their revenues are regulated and stable. So context matters a bit.
Okay, third metric, return on equity, ROE. This sounds like a measure of how well management is doing its job with our money.
That's exactly what it is. ROE is simply the company's net income divided by its shareholder equity. It's maybe the ultimate measure of how efficiently management is using the money shareholders have invested. Often reflects the strength of that moat, too. We want to see ROE consistently in double digits. High double digits, ideally. Company with a 30% ROE is generating 3 times more profit from its equity base than one with a 10% ROE. That means it can reinvest more, grow faster, and raise its dividend faster. High, stable ROE, great sign.
All right, finally, let's analyze the dividend itself. Check its health with 3 rules.
Yep, 3 quick checks. Rule 1, consistency. Have they paid any dividend for at least 10 years straight? Shows commitment. Rule 2, growth. Has that dividend grown faster than inflation over time? We need that real purchasing power increase. And rule 3, maybe the most important for safety going forward, the payout ratio.
The payout ratio, that's the percentage of the company's earnings per share that gets paid out as dividends. Why is 60% or less the target?
Because it leaves a cushion. A payout ratio of 60% or less means the company keeps at least 40% of its profits. That retained money is crucial. They needed to reinvest in the business, pay down debt, handle unexpected problems, maybe make acquisitions. If that ratio starts creeping up towards 80%, 90%, even 100%, that's a huge red flag. It means they're paying out almost everything they earn. There's no room for error. One bad year, and they might have to cut the dividend. PepsiCo usually stays safely below 60%, but McDonald's, around 2015, saw its ratio spike up near 70%. That signaled stress, maybe pushing too hard to keep the dividend growth streak alive when earnings weren't keeping pace. You have to watch that closely.
Okay, that detailed check on quality leads us right into Section 6, valuation, purchasing, and portfolio construction. We know what kind of company we want. Now, when do we buy it?
Right. We buy when it's cheap. Valuation is absolutely key, because even the best company in the world can be a terrible investment if you pay way too much for it. The lemonade stand analogy works well here. Say a stand makes $10,000 a year in profit. If you can buy that whole stand for $50,000, well, that's a 20% return right off the bat. $10 profit, $50 K price.
Yeah.
And you'd earn your investment back in just 5 years. You want that low price relative to the profit it generates.
And the main way the stock market measures this is the price to earnings ratio, the PE ratio.
Exactly. The PE ratio just tells you how many dollars you have to pay for every $1 of the company's annual profit or earnings. Let's use Walmart. Say the share price is $59.08 and its earnings per share, EPS, for the year was $4.66. You just divide the price by the earnings. $59.866 and a PE of 12.68. That number tells you 2 things. 1, it implies an initial earnings yield of about 7.9%, which is 1 divided by 12.68. 2, it suggests it would take about 12.7 years for the company's earnings to pay back your purchase price, assuming earnings stay flat.
And the rule from the sources for value-focused dividend investors, what PE are we aiming for?
We aim to buy these high-quality established companies when they trade at a PE ratio of 15 or less. That's the target. See, when the economy's booming, everyone's optimistic, PE ratios get inflated, they shoot up into the 20s, 30s, even higher. People are paying a huge premium for expected future growth that might never actually happen.
Okay, but hang on. If 15 is the target, and the market average PE is often, 20 or higher, does that mean we just sit around waiting, missing out on gains?
That is the patience part of being a value investor, yes. You often sit on your hands, holding cash, waiting for fear to take over the market. When the market tanks, a recession hits, some global crisis, just widespread panic selling, that's when the PE ratios of perfectly good, solid companies get crushed. They can drop into the single digits sometimes. That is what the source calls the candy store moment. When everyone else is freaking out and throwing quality companies overboard cheap, that's when you step in and buy. You get more shares and therefore more future dividends for less money.
So, buy when the PE is low. Got it. When do we sell? Because the whole philosophy sounds like buy and hold forever.
Selling is really rare. It should be. You only sell if the fundamental reason you bought this stock breaks down completely. Like 3 main reasons. 1, the company completely eliminates the dividend, stops paying altogether. It's a huge breach of faith. 2, the company's core business fundamentally changes for the worse. Maybe they take on way too much debt they can't handle, or their main product becomes obsolete, revenues start declining year after year, the moat is gone. Or 3, the dividend growth consistently fails to beat inflation over several years. If it's falling behind, it's not meeting our goal anymore. If the engine breaks, you sell it and find a new one. There's an anecdote about selling a company called ARCP immediately after they cut the dividend because of accounting issues cooking the books. That's a clear sell signal.
Let's apply this to Hershey, the chocolate company. Good case study.
Perfect case study. Hershey looks great on almost all the fundamental checks we just talked about. Incredible moat brand name, cash cow products people love, consistent growth in revenue and profit, low debt, safe payout ratio well under 60%. It's quality business. However, its PE ratio recently spiked way up, close to 39 when the source materials were looking at it.
Okay, so if our target PE is 15, what do we do with Hershey trading near 39?
Simple. You don't buy it. Not today. It's way too expensive relative to its current earnings. You put it on your watch list. You admire the company. You know it's good. And you wait patiently. You wait for the next market pullback, the next panic, whatever knocks that PE ratio down closer to 20 or ideally 15 or less. The dividend investor has to have that discipline. Market swings will happen. They always do. That's when you get your chance. Buying at a PE of 39 just locks in a tiny initial return and a super long payback period. Defeats the whole income purpose.
Okay, for the listener who's ready to actually do this, let's get practical. Nuts and bolts time, setting up, buying shares. How do we execute?
All right, step one. You need a brokerage account. If you're just starting out, especially saving for retirement, the recommendation is usually to open a Roth IRA first. Money goes into a Roth after you've paid taxes on it. But then, all the growth, all the dividends, all the withdrawals in retirement, completely tax-free. That's a massive long-term advantage. And use a discount broker. The source mentioned TradeKing back in the day, known for low commissions, $5, $10 trades, and offering free dividend reinvestment plans, or DRPs. Look for similar low-cost options today.
And when we actually place the order to buy, what's the best way to make sure we get that low price we waited for?
Always use a limit order. Never a market order. A market order just says buy it now at whatever the best price is. If a price jumps unexpectedly right when you hit buy, you could pay more than you wanted. A limit order lets you set your maximum price. Say the stock's bouncing around $51, but your analysis says buy at $48 based on that PE of 15. You set a limit order to buy only if the price hits $48 or lower. It guarantees you get the discount you are patiently targeting.
Okay, last piece of the puzzle. Putting it all together, can't just buy one stock, right? Diversification. How should we think about spreading the money across different sectors?
Absolutely critical. Don't put all your eggs in one basket, even if it's a really good basket. You need to spread your investments across different parts of the economy. So if one sector hits a rough patch, the others can hopefully carry the load. Based on stability, the strength of those moats, and just basic necessity, a well-balanced dividend portfolio might lean towards certain sectors. The recommendations for something like consumer staples, think food, drinks, household goods, around 20%. Consumer discretionary, stuff people buy when they have extra money, maybe 18%. Financials, banks, insurance, 17%. Healthcare, 14%. These sectors tend to hold up better during recessions because people still need to eat, take medicine, manage their money.
And that recommended weighting looks very different from the standard S&P 500 index, doesn't it? With its huge tech weighting.
Completely different. S&P 500, like we said, over 21% in volatile tech. And under 10% in those super stable consumer staples. That imbalance is why dividend investors need to be deliberate. We actively choose not to be overexposed to the non-dividend paying, often speculative swings of big tech. We deliberately favor the boring, maybe, the reliable cash cows, the companies that can raise prices steadily and because of that, raise our passive income stream steadily. That's keeping it simple but smart.
This has been, wow, an incredibly detailed look at a strategy that really boils down to patience, doing your homework on quality, and just being consistent. So to wrap it up, the dividend investor, they're kind of like the calm superhero in the often chaotic world of finance.
Yeah, I like that. They have this ability to stay cool, stay rational, when everyone else is running around screaming because the market's down. They see crashes not as disasters, but as buying opportunities. Time to analyze, pick up more shares of great companies on sale, lock in higher future income streams, and the whole time, they're getting paid. That realized cash flow keeps rolling in, whether they're working, sleeping, on vacation, just waiting for the next good deal.
So the ultimate goal isn't just keeping up with inflation, it's building a financial fortress, really. Maximum safety.
Absolutely. We talked about matching your job income, but maybe aim even higher. What if you built that reliable dividend income stream up to twice what you earn at your job? Think about the safety cushion that gives you. Protects you not just from average inflation, but from sudden spikes in costs, medicals, emergencies, whatever life throws at you. That's true financial security.
If you like this type of detailed book summary videos, hit that subscribe button now.